Well, it's a good morning from him, and it's a good morning from me. I hope everybody's well. Welcome to my mortgage live stream. I'm a Paul Archer, but you kind of know that, don't you? So you don't need me to introduce myself. Although Rishi Sunak's introducing himself to as many people as he possibly can at the moment, it looks as though this afternoon we might have a new PM since Boris pulled out, but that'll be good. He's a safe pair of hands on the economy. And I think things will look good. The pound will start to improve, and the gilt yields will come down. And I think it's good news all around. But we'll see, shall we? We're not here to talk politics. Hope everybody's well on this very late October. It's getting dark now, isn't it? Especially in the mornings and in the evenings too. Autumn is certainly upon us here in the UK. Got a couple of topics for you today. Couple of topics too. Do you like the Union Jack? See, I thought we'd put that on there as well because we're all patriotic, aren't we? Couple of topics for you today. The first topic I want to take a look at is the topic around the mortgage rate options that people have got at the moment, because there's a lot of talk at the moment, and Martin Lewis does his thing, and we'll talk about that in a second or two. And then I've got a little skills session for you called Taking the Mick, which is apologies to all people called Michael, but it's MIC is the acronym I want to share with you about how to handle the economic downturn that's about to occur. It's already started now. So let's get on to interest rates and all those good things, shall we? Now, as we know, Martin Lewis has the ear of millions of people. And I actually quite like the guy. I think he does a good job. I think he explains things well. He's got a great empire around him, and he's a very rich dude. But he has the ear of millions of people. And last week he talked about mortgage rates because it's a big thing. A lot of people are going to be affected by massive jumps in their mortgage rate. It's going to affect their cost of living more than gas, electricity bills will do. But certain segments of the population, I get that, who've got mortgages. So what I want to do is share with you some of the ideas that myself and some other mortgage brokers I know have been talking about to basically update yourself on some of the mortgage products that are around. So let's have a quick look at Martin. Here's a picture of our friend Martin Lewis, looking very young actually, that one. I think it was a picture taken from a few years ago. His hair's not so short there. But on Thursday, and this is a picture of him on Thursday because I recognised the dude in the back there, he was talking with his crystal ball there about interest rates and what's going on. And he talked about what happens with people who are faced with this issue around high rates. And that's what I want to talk about now, because your customers, your clients have got either a variable rate or they've got a fixed rate, which has come up for renewal, and they're starting to want to make some decisions about what to do. Now, nobody knows what's going to happen to interest rates. Of course we don't. But what we do know is that some of the fixed rate mortgages available on the marketplace now are quite expensive. So what I want to do now is take a look at the options available to the three different types of mortgage client you might get, just to upgrade you, really update you, make you think about the different options. Let's over to the whiteboard then for this one. So three different types of people that come to you for mortgages. The first type of person is your resi or residential customer. They call them resis, don't they, in our sector, because they do. But these are people buying a property either to live in or remortgaging or whatever it is they're looking to do. But they live in the property in which their mortgage is held on. It's known as residential. Now, at the moment, of course, you can look at a fixed rate. You've got 2-year, 3-year, 5-year, 10-year fixed rate mortgages. Now, are they temporarily high because of the problem with the pound and the mini budget last month? And the gilt prices, that's the big issue, isn't it? The gilt yields have gone up because of the LDIs from insurance companies. We talked about that last week. So the argument possibly is that these fixed rates are artificially high. So if somebody fixes themselves to some kind of 2, 3, 4, 5-year fix, then it's quite high, but we don't know. So what are the alternatives? Well, somebody on a residential, of course, they can go for say a 2 or 5-year fix, but you're looking there at sort of 6.5% or so, which is quite high considering they're probably coming off a 1.5%, 2%. Most people are. That's a big jump. Now, there are 10-year fixes. I saw a 10-year fix. The Nationwide had one at the weekend, and that's come in at 5%. So that's a little bit better. So you can see the short-term fixes are higher than the long-term fixes, which tells me rates are going to come down. So that's one option people can look for if they wish to. The other option, and this is the one that Martin Lewis talked about, was the tracker Now, the tracker mortgage is a different type of mortgage altogether. It's not the SVR, the standard variable rate. Now, the standard variable rate and the tracker mortgages are different things. Now, the SVR, the standard variable rate, I think that's what upset all the mortgage brokers about Martin Lewis. He talked about the SVR and people going on to the SVR. The SVR is kind of a false rate of interest. Let me share with you some numbers and figures on the slides now to show you how SVRs have changed. Let's just click over here for you so you can see where I'm going with this one. Well, the first one I want to share with you is what's happened to UK interest rates over the last 15, 16 years. Now, we know this, we've seen this sort of stuff before. As you can see here, you've got, we'll just flip back, sorry. As you can see here from the graph, those of you watching this, you'll see this. If you're on the podcast, you can't. But back in 2006, we had interest rates of 4 or 5%. This is the Bank of England base rate. Just before the financial crash, we had a Bank of England base rate of about 5.5%, 5.75%. Now, when the financial crash happened, the Bank of England base rate fell to the floor and remained at 0.5% for much of the 10, 12 years now. During the pandemic, of course, it went down to negligible. And now, of course, it's rocking and rolling upwards, as you can see. 2.25%, probably up by another 1% on the 3rd of November. So that's the Bank of England base rate, which pretty much influences every rate. Now, this is another graph for you, which you can see. Now, the blue line represents 5-year fixed mortgage at 75% loan to value. Now, this goes back to 1995. So this represents about 20 years of interest rates. Now, you'll notice that the 5-year fixed rate comes down all the way as we head towards the financial crash. The 5-year fixed rate wallows in around about sort of 5, 4, then goes down to 3, 2, 1% during the pandemic. And that, of course, has followed the Bank of England base rate. Now, the SVR in red here, you'll notice throughout the period 1995 to about 2008, follows roughly the Bank of England base rate and the fixed rate market. The two run together. Now, as soon as the crash happened, the SVR went right down and then trickled upwards. Now we can see now the SVR, the standard variable rate, is actually a whole lot higher than it really should be. Why is this? Well, you could possibly argue that the banks use this as their default rate for people coming off fixed who don't do anything. So they're trying to get some margin back. They're trying to get some profit back. But the SVR is about 6.5% at the moment, 6% for some lenders. That's really high. But the tracker's different. The Bank of England tracker is different. Now, I've found a really good tracker which tracks at it's Bank of England base rate, Bank of England there, plus this one I found was 1.25%. Now, the good thing about that one is there's no redemption penalties attached to that. You'll track the Bank of England base rate, whatever that does. And that's a good indicator of rates. The SVR is what lenders decide. So at the moment it's 2.25%, the Bank of England base rate. So that's 3.5%, which is not too bad. Yes, it'll probably go up by 1% next month. So that's 4.25%. But that's better than 6.5% fixed for 2 or 5 years with redemption penalties as well. This doesn't have a redemption penalty. So Martin Lewis did talk about the tracker being a good option for people. So that's residential then. Take a look at your buy-to-let. This is where it gets quite interesting now because we know about this. I'm going to put a different colour there for you. The buy-to-let market, in other words, the landlord market, who are also feeling the pinch because their rates are going up. Now, the buy-to-let market has traditionally had fixed rates. Typically 2, 3, 5-year fixes have been the popular ones. But they also have tracker as well. And that's something to think about. It's coming forward now. Obviously, you can have 5-year fix, slightly more than residential. Buy to let, it's a little bit more of a risk, isn't it? So you can certainly go for fix again. But a lot of these landlords are coming out of 1.5%, 2%, 3%, whacking themselves up to 6 or so. So again, think of the tracker, the Bank of England tracker. There you go, tracker. For a buy-to-let mortgage. Who'd have thought of that, having an interest on your mortgage, buy-to-let mortgage, of course, varying according to the rates. And I've got a tracker here, which is actually a 2-year tracker, which is pretty cool, isn't it? Think about it. So it's fixed, not fixed, but it has a 2-year term attached to it, but it's plus 0.75%. Plus Bank of England base rate, of course. Now, that's not a bad option for a landlord to consider if she's worried about fixing at 5 years at sort of 6 or 7% and not being able to come out of that. So, of course, that comes down to affordability as well, doesn't it? The rent, because landlords will, of course, put rents up. Most landlord tenancy agreements have got rent to be increased by CPI, by the Consumer Price Index. So they'll put their rent up if their mortgage payments go up as well. That's something they can do. So that's something to consider as well. The SVR, by the way, I look at an SVR for a buy-to-let. I picked one up at 6.5%. So if they revert back to the SVR, that's blooming expensive. No redemption penalties, I get that. You need to look at the tracker to see if there's redemption penalties. That's the key. So you can then redeem it in a year's time or whatever if rates do come down. Nobody knows. There's talk of them going up again next year too. Now, the other one, actually, which is really even more interesting, if you can get more interesting, is the later life market. There you go. Now, the later life market, of course, is the word we use now for equity release, people in their retirement years. Now, these are for people who are typically borrowing and rolling up the mortgage interest. Now, the marketplace here is priced differently. It's based upon the gilt funds, because insurance companies lend most of the money, and they have gilt funds which produce a yield, and they're lending that money. Now, of course, the gilt funds have been going up now recently. So the typical gilt fund a couple of months ago was paying about 1%, 1.5. Now, of course, gilt yields have rocketed in the last month. Typically now they're about 4%. Now, what insurance companies do is they try and lend at a higher rate than that, because that's how they make their money, of course, that's how they make their profit. So it's different kind of pricing. Now, I've seen a couple going on here. I've seen a fix. Now, of course, don't forget, in the later life marketplace, mortgages are fixed for life. That's the big difference. We have 2, 3, 5 year stuff over here, don't we? But they're fixed for life. And there's one here which I found at 6.5%, 6.5, fixed for life, which is quite a bit different. If you were to do the rule of 72 on that one, you've heard about the rule of 72. That's where you take a cheap calculator and you put in 72, simple as that, and divide it by the interest rate, 6.5, and that then tells you how many years before the mortgage doubles if it's rolled up, and that comes in at 11 years. So in other words, if the client fixed at 6.5, in 11 years, their mortgage debt will double. If they're rolling it up. So that's, you've got to look at those areas big time. Of course, that's quite high rate, that, compared to what it's been. And you need to look at that as well, of course. Now, what we're finding though with the later life marketplace is they're getting much more innovative with their thinking. We've got some really good firms in this market, Legal & General, Canada Life, people like that who are very innovative, forward thinking, and can change quickly. And there's a few schemes coming through now in the later life market. We've actually got RIOs, of course, where people actually pay some of the interest. And with RIOs, it's very different. You've got tracker mortgages there. I've seen a 5-year fix on a RIO at 6%, quite high, really. But I've seen a tracker at Bank of England plus 1.8%. It's a bit higher as well. But Bank of England plus 1.8 tracked. Again, these can be redeemed, you see. There shouldn't be any redemption penalties on the tracker. You need to look at that, of course. So you could look at that as a temporary measure. I can see, though, mainstream later life lenders now lending on more of a variable rate, maybe Bank of England tracker for equity release. It's a different concept, but I can see that coming in if these fixed for life rates get really high in the next sort of 3 to 6 months. So what I'm saying to you then, there are options as a mortgage broker. Don't just go for fix all the time. Look at the client situation. Of course you should do. You should look at their situation, what's going on, what their future is, do a lifeline on them, find out where they're going. Because fixed rates have redemption penalties, and that's the big problem. Figure out their attitude, their risk attitude, of course. It tends to relate a lot more to wealth planning than mortgage. But risk comes into it. So the client's circumstances need to be looked into. Of course they do. Go out saying that's what our industry is all about. But you can look at alternatives than the old 3-year fixed rate. You don't have to go for that one. So what's going to happen to interest rates in the future? Well, Bank of England are coming in on the 3rd of November. They'll probably whack it up by 1, maybe a bit more. So we'll have Bank of England base rates about 3.5%. Maybe next year they'll trickle up if inflation isn't controlled. Depends what Rishi does. He's a safe pair of hands on the economy, so it could look good. But as a mortgage broker, be aware of what's happening in the marketplace. And don't forget trackers. They're a particularly good scheme to have. I hope you found that useful. Bye. Well done, everybody. Okay, let's move away from that kind of technical thing, or is it on interest rates? What I want to do now is just to share with you some thinking for the downturn that's coming in. Now, what is this down? I don't want to frighten people, but the fact is you've got to be a bit realistic. You can't be naive with what's going on. I'm going to give you 3 ideas to help you with the impending downturn that's coming into the marketplace. Now, we've had a terrible budget turmoil recently, haven't we? We've had a war in Europe, of course, which is continuing onwards. We've got rampaging inflation now, which is biting into other goods and services, particularly foods and other things as well. Business is tailing off. However you look at it, it is tailing off. And you might be speaking to lots of clients, but it may well be that your completions have fallen. Clients might be stalling, pausing, taking a breath, waiting for things to calm down. For example, you might have seen a lovely couple in the summer, a young couple who wanted to buy their first place, got their deposits, you got everything done in a decision in principle, and they said they were going to find a place in the autumn. Now they've decided not to. They renewed their short hold tenancy for another 12 months at a good rent. They're happy with that. And they said, well, they're going to look at the housing market next year in case prices come down. That's what people are thinking. You can't stop them thinking that. People are like that. So things have calmed down. Now, you might have a few product switches keeping you busy. There might be some protection advice that you're doing to past clients maybe, and that's earning you some good commission as well. So, your business is ticking over, but not busy as perhaps you want it to be. Now is your time, of course, to take stock of the situation and kind of control how you're going to be looking at yourself in the next 6 months or so. And I'm calling this taking the mick, which is my acronym. So let me share the mick with you. Let me share the acronym with you. It's MIC, which, apologies to all Michaels of the world, taking the mick. And there's 3 things to take a look at here for you. The first one to take a look at is making contact. The second one is you're in a game. And the third one is CPD. In other words, continued professional development. And I want to talk about these 3 for you. Just briefly, just to give you a few more thoughts about what you need to be doing here. Now, the first one there for you was the M, making contact. What we need to be doing now and way into next year is to start to ring fence your client base. Now, I was chatting to some people this morning about IFAs being acquired by large firms. There's a lot of acquisitors going on. They're acquiring lots of firms, buying them with private sector money, private equity money. And they're buying pretty much the client base from the IFA. The IFA is retiring. She's retired. But there's a client base there with funds under management. It's the client base that is worth the money. Now, as a mortgage broker, mortgage advisor, you will have a client base. I know those clients belong to other people as well, but you have them on your CRM system. Now's the time to cuddle them, closet them, ring fence them as much as you can. Contact them each, phone them, have a quick meeting on Zoom, just to reassure them, update them on how things are going in the mortgage market. Just make sure that they remember you and who you are and what you can do for them, and readily contact them over the next 3 to 6 months. Really closet your client base. That's making contact. That's the first thing you need to do. The second thing you want to consider is your inner game. The inner game. Now, what you have to do here is think about your mind. A lot of people, when they're faced with something they're not used to, like a recession or a downturn, freeze. Their mind freezes. Their motivation goes and they start thinking negatively. You can't help it. If you're unaccustomed to a slowdown in the economy and you haven't seen one before, then the whole concept scares you to death. The fact is there's been many in the past, and that's fine. But what you need to do here is to create and get yourself some resilience strategies, some ways in which you can keep positive and keep that motivation going. And there's all sorts of tactics and techniques you can use. I've got my book, NLP and Selling, which you can obtain if you wish to. My book might help you with that, and I'll take a look at that in a second for you. The other thing, though, to do here is to find somebody, get yourself a mentor. Mentors are great because they're usually free. Somebody who's in the sector, who's been around for a while, who's experienced recessions and downturns before. Those people will show you what to do, how to handle things, because they can advise you. They've been through it before. But it's all about managing your inner game, because if you don't, you'll freeze. You'll just get scared and you'll watch the news. It'll be like the early days of the pandemic, where all we did was go onto the news, didn't we? We know what was going on. We had never experienced it before. Unprecedented, they said, didn't they? But the fact is that downturns are not unprecedented. They've been around for many, many years. So that's number 2 for you. The third area for you, the C, remember we're talking here about, let's put this up for you, you can see them, the CPD. So make contact with your clients in a game, CPD. Now CPD, again, I've talked about this before, but what you need to be doing over the next 3, 6 to 12 months is taking the opportunity when things slow down a little bit to advance the old brain, which is all you have to sell. Plus software, of course, but it's the brain. Advance your CPD, maybe update your skills. Update your regulatory permissions is something that will probably pay dividends for you. Think about equity release as an update. You can get the exams for that one, get yourself slipped over to that marketplace fairly quickly. Think about development finance, corporate protection. Get your RO5s, your Cert Pros in as well, the protection advice. Development finance, of course, is a key area now. And during a recession, there's people with cash who'll buy rundown properties, do them up into flats, flog the flats, or rent them probably if house prices come down. There's a lot of that going on because builders are cheaper now. Building materials will start to come down as we bite recession, bite the inflation. So the next year to 2 years, there's going to be a lot of development going on, and you'll be wanting to be there to finance that. So that's a sector to think about as well. The other one, of course, is financial advice. There is a dearth of financial advisors. Every statistic you ever read tells you that there's few financial advisors. I'm talking about wealth managers, pensions advisors, those sort of people. There's not enough of them. There's not enough of them, and there's so many people wanting that kind of advice. And it's a natural knock-on to what you're doing now. So get yourself on that one. We're starting up an academy next year. We've got Paul Archer's Financial Advisor Academy, in which we're going to be getting you into the exams, getting you all the regulatory side of things, but also the skills as well. So it's a different world, you see. You have to operate differently for that one. So we're very excited about that moving forward. But that's coming next year. So CPD, take the opportunity to update that brain of yours, which you can then diversify your business into areas that are not affected so much by the recession. So take the mick is really the key to it as well. By the way, if you're interested in those books, I've got one like NLP and Selling. Let me just share with you the book system over here, because I just want to share with you how this works. Here we go. Let's go over to my books. Here we go. Here we go. So we can get this one working for you. Here we go. There we are. Let's just flick over so you can see the website. This is my Lulu page, which is our publisher. And over here you can see all the books that we have. You probably know about these things, but there's the equity release, and obviously you've got all the CMAP stuff there as well. But this is one there, NLP and Selling is a key one. Let's zoom in there for you. That one's got a ton of stuff in there on resilient strategies, engaging the brain, making sure that you can operate yourself. So you can get that on Lulu. It's on our website as well if you want that one. We've got the mortgage one there as well, of course. We've got there are mortgage advising new rules. That's one to take a look at. There's a chapter there on inner game as well, so you can certainly read that. I just wanted to share with you some of the books that might help you. They're not expensive, are they? 14 quid ain't expensive to buy. We don't do the Kindle, so it's proper books in which you could open up and read. Yeah, that's a thought, isn't it, to take you forward? Alrighty, so is everybody well? Is everybody good? I hope you're all fine. I hope you're rocking and rolling. It's an interesting times, isn't it, in our sector, as always. Remember, if you can be flexible and change, you have the dominance. The NLP talks about the person with the most flexibility has control of the system. And that's quite true, isn't it? If you're able to adapt and be flexible in the way you operate, you have control. And that's the key to the future as well. So we'll be back next week. Hope you've enjoyed the live stream today, and we'll see you again soon. Bye-bye now.